Imagine Apple, Microsoft, or another giant stock sliding down to a key support level. This is where things get exciting. If the stock rebounds, you could capture unlimited profit. And if it stalls, with the right strategy, you can still come out ahead with a small gain. Of course, you could just buy shares, that's fine. But what if the stock stalls? Do you really want to sit there waiting? Or would you rather use a strategy that still pays you, even if nothing happens? The good news is there's an option strategy built to solve this exact problem. It combines selling an out-of-the-money put with buying an out-of-the-money call, and the result is what traders call a risk reversal. And today we'll show you how to set one up, find it on Option Samurai, and even use advanced variations that pros rely on. A risk reversal is simple. You sell a lower put option and buy a higher call option. Usually both options are out of the money. The put strike sits below the current stock price and the call strike sits above it. To understand the risk reversal, break it into two trades. First, selling a put. That means limited profit if the stock holds steady, but unlimited downside if it collapses. Second, buying a call. That means limited risk on the premium, but unlimited upside if the stock rallies. The short put gives you income. The long call gives you unlimited upside. Put them together, and you've got a strategy that can cost little or nothing to open, with uncapped losses, unlimited potential profit, and a nice plateau in the middle where you can still make money if the stock price does not move. Now that you've seen how the risk reversal is built, let's compare it to the two classic bullish strategies it combines: the naked put and the long call. First, the naked put. You collect a credit up front, profit potential is limited, but probability of profit is high. It works best when you think the stock probably won't drop much. Second, the long call. This one costs you a debit but gives you unlimited upside. The trade-off is lower probability of profit, so it's best if you expect a sharp, fast rally. You put these two together and you get the risk reversal. Often set up for little to no cost, sometimes even a credit. It gives you unlimited upside, a moderate to high probability of profit, and it's perfect when you believe the stock won't fall much, but could also rebound strongly. So how do you actually take the risk reversal to the next level? It starts with choosing the right stocks at the right time. One powerful approach is to look for stocks that are oversold and have strong upside potential. Here's what you could do. Sell a put just below support. Buy a call that costs a little less than the put. If the stock stays flat, you can often still walk away with a small profit and repeat the process. If the stock rallies, that's where the unlimited upside kicks in. So, how do you spot those setups? You can use RSI to measure oversold conditions. You can use analyst target prices or your own analysis to gauge upside potential. Both of these data points are built right into Samurai, so you can scan the whole market for them in seconds. Now, what if the stock drops instead of going up? That's the risk side of the trade, but the good news is you have three clear choices. First, roll the trade forward. That means closing this trade and reopening it with a later expiration date. You can even adjust your strike prices lower to give yourself more breathing room. Second, transition into a wheel. If the call you bought expires worthless and you get assigned shares from the put you sold, you'll own 100 shares. From there, you can sell a call against those shares and continue with a covered call. That's the start of a powerful strategy called the wheel, and we'll cover it in a full video soon. So make sure to leave a like, subscribe, and hit the bell so you won't miss it when it drops. Third, simply close the trade. Sometimes you just take the loss, move on, and save your capital for the next opportunity. No trader wins every time, and that's perfectly fine. The key is this: if you take enough trades with an edge, your long-term results can still come out positive. We've shown you how to manage the trade, now let's see how to find the best setups using Option Samurai. Remember, the key is picking the right stock at the right time. You can start with our predefined scan to get results instantly, but we'll show you how to build it yourself because the more control you have, the stronger your edge becomes. Let's see how to build this on Samurai. Start a new scan. Choose Custom Strategy. Add 2 legs. Sell 1 put. Buy 1 call. Then you can fine-tune the scan with filters to match your trading style. For example, RSI below 30. That's a classic sign of oversold conditions, where a bounce is more likely. Fundamental score above 5. This is one of our proprietary indicators, and it helps you focus on stronger companies. So even if you get assigned shares, you're holding quality. Probability of profit over 70%. That way, you're stacking the odds in your favor right from the start. And if you want to add more fields to your scan, just click the Add Filters button. And look up any of our many additional data points, such as the analyst's target price. Click Run Scan and wait for a few seconds to see the results. You can select each row to evaluate every single trade returned by the screener. And that's it. In seconds, you'll have a list of risk reversal trades tailored to your exact style. And stay with us because in just a moment, we'll show you a few powerful variations of this strategy that pros love to use. Now here's where it gets interesting. There are variations pros use to adapt the risk reversal, and in a few seconds, you will also be able to trade like a pro with Option Samurai. The first chart you see here is what we have showed to you earlier, and it's called a long risk reversal. The second one you see is the mirrored image of the long version, which we can call short risk reversal. And the third one shows you that you can be more creative with the risk reversal strategy and set up any adjusted version you prefer. For instance, you could sell 2 puts and buy 1 call. Let's start from the short risk reversal. Here, you just flip what you did earlier. You buy a lower put and sell a higher call, both out of the money. That's a bearish risk reversal. Same idea, but for downside moves. Second, you can change the ratio. Remember how we told you that you can take this strategy to the next level? Here is something you can do in that spirit. For example, you may sell 2 puts and buy 1 call. This gives you even more premium upfront, still with unlimited upside. But the trade-off is bigger risk if the stock crashes. These are only 2 examples. There is no limit to how creative you can get with this option setup. Let's recap. A risk reversal means selling a put below support and buying a call above the price. Unlimited upside, little or no cost to enter. You can improve it by focusing on oversold stocks with strong upside, or even by adjusting the ratio, like selling 2 puts and buying 1 call. And remember, with Samurai, you can compare different trades, test variations, and even paper trade them, so you can practice before going live. Today you learned the basics of the risk reversal, but this strategy has hidden variations that can take it even further. You can scan the whole market for any variation of the risk reversal through our custom strategy screener. Samurai scans millions of options in seconds. Sign up for a 14 days free trial. Option Samurai. Find your edge now. And if you want to learn more about options trading, check out this video.